Let me ask you a question. Have you ever found a deal that looks incredible? It's got a big IRR, it's got a polished deck, a slick operator who answers all your questions, and still thought, why does this deal make me feel nervous to wire money? And you're not crazy. This hesitation is what saves investors when they're thinking about doing a deal, but it also is the same feeling that traps them because the truth is that most people don't feel confident investing. And it's not because the deals are bad. It's because they've never learned how to actually vet them. They don't know what to ask. They don't know where the risk hides, and they've never compared enough opportunities to see the patterns. And so they either freeze or they do the deal and trust the wrong person. And both outcomes cost them years and sometimes hundreds of thousands of dollars. And so if that's ever been you staring at a deal and not knowing what questions to ask, this episode today is going to be a game changer. And I'm going to walk you through my real due diligence checklist, the same exact questions that I use specifically when vetting private debt and credit funds. And by the end of this episode, you're going to know exactly how professional investors, I consider myself a professional investor, think and do due diligence on private equity deals, and you will not look at a deal the same way again. So, hey everyone, this is Pascal Wagner, and I'm the host of the Passive Income Playbook, part of the Best Ever CRE show. And for those of you who don't know me, I am a former venture capitalist who managed and deployed over $150 million working at Techstars, one of the most active venture capital firms in the world. And since then, after leaving the firm, I personally invested over $3.3 million into 23 private equity deals, everything from self-storage to multifamily to oil and gas to private credit to venture capital. And from those investments, I've been able to write off over $500,000 off of my income. And I've been able to generate more than $100,000 a year for the last several years for my family using passive investing. So I've also coached over 21 wealthy clients through one-on-one coaching through my Cash Flow Academy program, where I walk through this exact due diligence process. So what you are getting here is something that I am actually doing today and coaching other people with. So it should be packed with a lot of things you can take away. So before we dive in, two quick things to help you take this a little bit further. The first is my freebie. Grab the Passive Investing Starter Kit at passiveinvestingstarterkit.com. You'll get access to my real-time database of over 800 different deals. So if you're struggling to find deals to do due diligence on, that is a great place to go. And if you want to apply a lot of what you're using or learning in today's episode, that'll be a great place to find deals. Secondly, if you want to meet hundreds of fund managers and LPs in person so that you know actually who you're wiring money to, mark your calendar for the Best Ever Conference happening February 18th through the 20th, 2026 in Salt Lake City. This year is celebrating 10 years of the Best Ever Conference. And so there's going to be, they're going big this year. And you're going to be able to hang out with people like me. I'm going to be teaching a workshop. I'm also going to be giving a keynote on the center stage. And there's going to be a lot of action happening. So tickets right now are $695, but they always increase. I think last year they made it all the way up to $1,200 or $1,300. So be sure to go to besteverconference.com and use the discount code podcast10. It should be all caps podcast, then the number 10 for 10% off. And with that, just wanted to get that out of the way, and let's make sure that we dive in. Okay. So most investors never actually learn how to do proper due diligence. They binge podcasts, they download decks, they listen to operators talk about, the double-digit returns they're going to receive. But when it comes to writing a check and actually investing in the deal, they freeze. And they ask, several surface level questions when doing the deal. I find if you're new to this, you're probably asking less than 10 or 20 questions when you're actually talking to the operator. If that is you, this episode is geared towards you. That is way too few questions. And it's very clear that you're not doing enough due diligence. So meanwhile, experienced investors are asking hundreds of questions. They're checking the leverage. They're understanding, the background of the people. How long have they been doing this? They are looking at loan tapes. They're maybe looking at audited financials, and they can smell when something doesn't add up because they have a system, a checklist, and they're just using it and going through the reps. And the reality is that this is work. Confidence doesn't come from hype. It comes from process. And so in this episode, I'm going to show you mine. So look, I think first and foremost, before we even get to this process, you want to make sure that you have a thesis, that you understand why you're investing. Am I investing for cash flow? Am I investing for equity growth? Or am I investing to reduce my taxable income? You might say, hey, I'm investing for all three of those. I actually think that's a terrible answer. And that means you are not clear on why you are investing. So it's usually the primary indicator is for one of those three reasons. Then you should have a deal flow process where you have deal flow coming into your world, and you are using your investment thesis to filter those deals. If you haven't done either of those two things, I have several other episodes where I've covered that. I'm not going to cover that here today, but I highly recommend checking out my other content either on the Best Ever podcast or on my own personal YouTube channel. But this is specifically what happens after you have identified the top 10% of deals that match your investment criteria, that have the initial green light, and you are ready to spend at least, let's call it 2 to 3 hours digging into the deal. And my process here is simple. So after it's gotten the initial green light, it's crossed the initial filters, I am taking the pitch deck, I am looking at the webinar, I maybe am emailing the operator for what's called a DDQ, a due diligence questionnaire, which is could be 100-page PDF where they go through and answer a ton of, basic questions. Any institutional or high firm that's raised a lot of capital will likely have a DDQ. If they don't, that just means you're probably dealing more with an emerging manager, and just something to note about, right? And you're also maybe asking the operator for, hey, can you send me some podcasts, some interviews that you've done so I can do as much of the research on my own before I waste the time of us both hopping on a call. So I'm gathering all those resources and then setting up a call secondly. So how does this work? So let's start from the top. Imagine this. So after I have found a deal, I've asked the operator, I maybe sent them an email, didn't hop on the phone yet, and I'm collecting all these basic resources. And then I pull up my Google Sheet, my deal research checklist template. I make a copy of that template for this specific deal. In that template are over 100 different questions in one column. And then in the second column is the answer to that question. And then the third column are any comments or any additional detail related to that. So very simple, 100 rows, 3 columns, our own specific template for the deal. And so my process from here is I go through all different types of sections. The sections start out with what are the basics about the manager and the team? What are some basics about the fund or the deal in general? One section is all about the performance and the structure of the deal. One is specifically diving into the loan details of what their underwriting process is. And the next section is investor experience. You tell me about how many investors are in the fund, minimum investments, things like that. And then I have my kind of external due diligence processes that I am doing on my own. And then ultimately making a list of all the supporting materials I have found related to the deal. So I'm going to go through each of these sections one by one so you can understand the amount of detail that I'm going through. And I will tell you that after coaching 21 different clients through this process, that if you are not asking these questions, I can probably take a guess that you fundamentally don't understand the deal. And each of these questions is supposed to be a way of just making sure I'm asking the same question to every single fund so I can start to see patterns and trends. And what you may also notice as I read through these is that many of the questions might even sound the same. And in fact, they are, but they're asking the question in a different way. And the purpose of that is to elicit more color and information about the deal. It's very easy to go in and ask a question, the operator answer it, and then you think that you know everything there is to know. And what I've found is that by asking the same question in a couple different ways, I usually get a lot more color and insight than I initially thought. And so I think that's very important just to kind of like make a mental note of as you're going through these. But let's dive in right at the top, which is the basics. So at the very top of my list is I start out with the very easy basic questions. Okay. It is everything from, okay, who is the management team? Who is the company? So, maybe I will use, it might be, hey, I'm looking at DLP Capital, and that is the name of the management company. Then I'm looking at, okay, what is the name of the deal? Okay, so maybe I'm looking at the DLP Lending Fund by DLP Capital. All right, we're covering all the basics. Who is the CEO? I'm putting their name into the checklist. I'm looking on LinkedIn, finding their name and adding the link to their LinkedIn in my profile. Why? Some of these things are very basic. You'd be shocked at how many firms I come across where the founder doesn't even have this in their investment firm or the management company listed on their LinkedIn. Very basic information, and immediately helping me catch a red flag that I can start knocking out deals from my process. I'm asking, who are the key team members beyond the CEO? Who is the C-suite? How long have they been there? And I'm looking up those people, going on LinkedIn, adding them. Have they been there a while? Are there a lot of them? Are there a few? Is there no one really else because they're an emerging manager and it's maybe them and one other person? I'm asking, when was the firm founded? How many employees does the management firm have? Is it a team of like 3 people with a bunch of extra contractors, or is it more of an institutional firm and they have 30 or maybe even 300 employees? Good color to know when you're about to invest in this firm. I'm asking, what is the firm's assets under management? If I'm talking about DLP Capital, for example, one of my favorite funds that I love investing with, I have over $1 million with DLP. Not an endorsement, but one of my favorites, have over $5 billion under management. Cool. Now let's ask, what is the fund's assets under management? The fund that I am investing in, how much assets do they have under management? This is a $1 billion fund, 800K of which is currently in the fund, and they still can raise an additional 200 before that fund closes. How many funds or vehicles has the investment firm launched to date? Okay, well, if I basically want to understand, okay, well, DLP Capital has 4, 5, 6 different vehicles. They've got the DLP Lending Fund, the DLP Preferred Credit Fund, the DLP Housing and Communities Fund, and so on, right? And so I want to understand, Do they have a small team and they have a bunch of opportunities, or do they have a big team and a bunch of opportunities? These are all just data points that go into understanding the deal. I am, going through and asking, has the manager ever lost investor capital? Usually, when I'm going through this process, I'm first looking at the deck or a webinar. And they'll either tout that they've never lost investor capital, or they won't mention it, right? And so that's a good follow-up question. I'm asking or going through, is there a key person succession plan or a backup plan in place in case the CEO or the fund manager passes away or gets hit by a bus? Are there any pending litigation issues? Typically not things that you find in a deck, and that's usually something that I need to ask in my follow-up. Very interesting to see how a fund manager responds. Oh, hey, we had this lawsuit several years ago. You can look it up. It's buttoned up. Or, maybe they won't mention anything. And that is something that we are going to double check and verify later in our due diligence process. But these are all just the firm basics, firm and deal basics. So then I'm going into section 2, which is the fund basics. What's the name of the fund? What is the story of the fund? How did it come to be? How did they see the opportunity and decide to go in on it? I have a question that, what is the fund's investment strategy? When was the fund founded? How many investors are in the fund? What is the max assets under management allowed inside the fund? What is the current assets under management of the fund? What specific asset classes does this fund focus on? Some people are like, we only do this type of loan. An example, as I started doing research with a bunch of different debt funds, I came across funds where they said, look, we only give hard money loans to multifamily properties in New York. And then you come across other funds and they're like, we give out loans to everything. We do single family, multifamily, self-storage. We'll give loans to industrial properties. And they don't seem to have a focus, or they say that their focus is just a certain type of risk profile. You want to figure that kind of stuff out and just have it very clear in your research checklist. Something that I'm usually asking that's not found beforehand is, how has the fund strategy shifted since inception? If the fund's been running for 5 years and they haven't shifted their strategy at all, that is typically a question mark, a yellow flag. Wait, so you're telling me you've done hundreds of loans and the exact strategy that you set out to tackle, you did not learn anything in that process and you haven't shifted? Like, that smells like BS to me. And so, as I said, another data point we are thinking through, but something that would cause me concern. You better bet that over the last 5 years, as interest rates have risen, or that insurance has become more expensive, or that housing values are at all-time highs, that a fund is not changing their strategy over time to make sure that they're only finding the best fit loans. Something I'm also asking is, how much does the sponsor co-invest in this fund? How many of the senior leadership team, how much has the CEO invested in the fund? How much has the entire team invested in the fund? Is that 1% of all assets under management? Is that 10%? Is it, in aggregate 2 million, or is it 200,000 out of a $100 million fund? Just data points, very helpful to know. What geographic markets does the fund operate in? How diversified is the fund by geography? Do they have, 25% of their loans in a certain state and the rest is spread across everything else? Is it all pretty even? Something that's good to know. How diversified is the fund by borrower type or project? What percentage of the fund is concentrated in any one single borrower or project? Again, so these are all just the basic questions around the fund or the deal that we're investing in. So again, all we're doing is we're looking at the deck in the webinar. We have this big checklist open, and we are just, reading through the deck and trying to add little answers into our Google Sheet of what we know about the deal, and we're putting it in there. My third section that I typically go into is then around fund performance and its structure. So I'm asking everything from, what is the target IRR of the fund? Is there a preferred return? Okay, what was the fund's return in 2024 or in 2023 or in 2022? I will tell you, from after having just done a bunch of research of interviewing over 75 different operators in the debt fund space, you learn quite a bit about how people answer these questions. Some funds might not have had a great return profile in a specific year. And they'll come and answer it as like, it's October right now as I'm filming this. And they'll say something like, oh, like over the last 12 months or the last 24 months, our return is X. And that's not the question that I'm asking, because they're the ones setting that time frame. And now I can't compare, October 24 to October 25 across all the other funds that I'm seeing. But I can compare, okay, this fund generated this, 10% in 2024, and this other fund generated, 9% in 2024. Now I can compare apples to apples. And so when a fund says, hey, here's what we've returned in the last 12 months, that's something I double click on. I dig into, and I'm like, hey man, thank you for answering that. That's not my question. Can you provide me the answer to how much did your fund return in 2024? And these are things that are okay to push back on, and you should push back on them. And, I highlight these things because when I first was an LP investor, I didn't know what questions were okay to ask and if it was okay to push on any of these things. And I think that's one of the biggest things I'm hoping I'm giving you in these episodes, is that if you are going to be giving someone $50, $100, $200,000, you should get answers to any kind of question that you have, because if you're going to be giving someone that large a sum of money, they need to be absolutely transparent and forthcoming with that kind of information. As I continue down this list, other questions I ask are, okay, how often are returns distributed? Are they monthly, quarterly, biannually? Great questions that I think people miss are, what is the current leverage ratio of the fund? And in addition to that, what is the maximum leverage permitted by the fund? Something that I've learned after interviewing a bunch of different operators, if you try and ask both questions together, hey, what's the current and max leverage of the fund? They might only answer the first part and then not answer the second part. And so that's where you need to go in and double click. It's shocking to me how, you might say, hey, how much leverage does the fund take on? And they might say like, oh, we only take on 20% leverage. We really don't take on that much leverage. Not really anything to worry about. And then I'll follow up with the question of, okay, but tell me about how much max leverage you can take on in the fund. And sometimes they either A, don't know if they're an investor relations person, which is a flag, or B, sometimes it can be a high number, 50 or 100% leverage. And then you need to ask yourself, okay, well, right now the leverage is 20%, but you're allowed to go up to 100% leverage. That's still a risk. And because it's in the PPM, you shouldn't expect that the fund will always only maintain its current leverage ratio. I always think about what is the worst case scenario. Because if you are investing $100,000 and you go back to your normal everyday life, you are not going to be paying attention that the fund over the next 2 quarters takes on a whole bunch of extra leverage that you were not expecting. And so understanding these questions before you get in are very important to understand. And I usually go in with the idea thinking that whatever the max is, I should assume that the fund will take that amount of leverage, and I need to be comfortable with that. And then, in terms of structure and performance, the last couple questions I'm asking here are, is the fund open-ended or closed? Will the fund always be open for the next foreseeable future? Or Are they raising, let's call it 10 or $100 million, and the fund closes and there's no opportunity to get back in? And something I'm also typically asking is, has the fund or the management firm ever experienced any capital calls or pauses in distributions? Have you ever needed to gate the fund for redemptions? And that's, at least when I interviewed a bunch of these debt funds, they'd say, you know what, when COVID happened, we gated the fund and paused distributions for a quarter or two just to make sure there was no run on our fund and that we still had enough cash flow to handle any unforeseen circumstances. And then we back paid those investors for those months we didn't do distributions and then continued moving forward. That would be, depending on the type of investor you are and what you're looking for, an acceptable answer to me. But definitely a question you still want to ask. Okay, then, we're getting into the category of the actual loan details. I want to understand, how are loans underwritten and brought into the portfolio? What is the credit criteria? So I'm typically asking, okay, how many deals are you looking at? Like in the last year, did you look at 1,000 deals, 300 met your initial criteria, and then you funded 50 of them? What is the criteria to get funded by you? Is it the borrower needs to have a credit score of at least 700. The project size needs to be between 500 and 1.5 million. You want them to tell you a story and give you as much detail as possible. I'm also asking, who on the sponsor team specifically handles these? Is it one person? Is it a committee? Is it a committee, a person, an employee that's kind of like doing the basics, and then they bring all of the loans that they think should be accepted into the fund and they present those as a weekly meeting to the CEO, and the CEO signs off on them? You want to understand what that process looks like. I'm asking, what does the typical borrower profile look like? Is it only first position loans in the fund? Are they secured by assets, or do you have unsecured or second position loans in the fund? You have second position loans in the fund? What percentage of the entire fund do these second positions make up? Is it 95% first position loans, and then in unique opportunities where they know the borrower for a long time, they might give them a second position loan on top of it? Or is the fund 70% first position and 30% second position loans? Something that's the amount of risk that you're taking on. The more second position loans there are in the portfolio, the more you take on. Okay, historically, what's been the max amount of second position loans you've had in the fund? I'm asking, how many loans are currently in the portfolio? Oh, okay, so you have a $10 million fund, and there are 100 loans in that fund. Okay, so each loan in there on average is $100,000. Got it. Is that what it is? What's the average size of the loan? Are the loans secured and personally guaranteed? What happens if the loan defaults? Do you take it over and sell it for pennies on the dollar? Do you take it over and finish the project? Do you have expertise in-house to finish these projects? Do you have another fund? For example, I know about the DLP Capital Lending Fund. If they have loans that are underperforming and they need to take over that asset and bring it to completion, oftentimes they will sell that underperforming loan to another fund of theirs, and so that the debt investors in that fund don't need to take on that risk, and they also just make it so that there are not as many loans that are delinquent within their portfolio. Something that's helpful to know. Also, what's the historical default rate? Do they have 1% to 2% of their loans are in default at any one time? Or I've heard as much as 10 to 20% of their loans are in default. To me, the more loans that are in default in their portfolio, the riskier that it is. It was kind of crazy. This last week, I was talking to a fund, and they had over 13% of their loans in default, which meant that a borrower had not made a payment in the last 60 days towards their portfolio. That is a flag to me. And so that's where I'm digging in deeper. Okay, why is that number so high? What was that number in the previous year? Oh, in 2023, you only had 2% of loans in default, but right now you have 12% in default. Like, why? What are you changing? What have you learned? And you really want to understand how this person thinks about managing this kind of risk in their portfolio. What is the average loan to value that you have in the portfolio? Are you you're lending on $100,000 property and you have you're only giving $70,000 in the loan. That's a 70% ratio. Okay, that's the average. But tell me about inside the PPM. What is the max loan to leverage or loan to value ratio allowed in this fund based on the PPM? And, very interesting answers that come up. Our average loan to value is 65%, but our loan to value allowed in the PPM can be up to 90%. Okay, well, why is it so high? Are good questions to be asking your operator. What is the typical interest rate charged? Who services the loans? Are you servicing them in-house, or do you originate them and then you kind of hand off the loan to someone else to go after? And what percent of your borrowers are repeat borrowers? All great questions to be asking about how they actually, what is the makeup of the loans within their portfolio. Then my questions will shift to kind of the investor experience. I want to ask, like, okay, what accreditation is required? I mean, this probably should have been in your filtering criteria before you got here. But, do you accept accredited investors? Do you have to be a qualified purchaser or a qualified client? For instance, an accredited investor, you have to have $1 million net worth or more, excluding your private primary residence. Might have this mixed up between qualified purchaser and qualified client, but I think a qualified purchaser is, you have to have at least a $2.5 million net worth, and a qualified client is at least a $5 million net worth. Or I've switched to one of those two, but you get the idea. I'm asking, what is the minimum investment? And they might say, oh, our investment minimum is $200K. Okay, then you might have a follow up. Okay, do you make any exceptions for first time investors? Is there something lower that you would accept? Always a great question to ask if it's your first time working with an operator. You're asking, what is the lockup period? Is there a year lockup? Or if I put my money in this month, if next month I want to ask for my money back, can I do that? And then what's the redemption policy? Like, I put in my request, how long does it take for me to get my money back? Is it a quarter? Is it a couple weeks? Is it by the end of the year? Does the fund issue a K1 or a 1099? Or is the income taxed as ordinary income, at my normal tax rate, which could be anywhere between probably 30 and 54% if you're in California, or is it taxed as qualified business income at a 20% tax rate? Very important. If you're investing out of your IRA, then you're probably asking questions like, is the fund subject to UBIT? And basically it's like, will I have to pay taxes on any of the interest earned in my self-directed IRA? Usually, if there is leverage in the fund, there will be UBIT. There are ways that they can get around that, but that's at least a trend that I have seen. And so that's something that I pay attention to for all my IRA investors. Is there a compounding option? Can I invest in this fund and have it just compound, or do I need to receive the distributions each month? How frequent are the updates that I'm going to get from the fund? Are they monthly or are they quarterly? Is it in video form, or is it like an email report, a summary? I'm asking, a big question is, when do you send out your tax forms? And actually a better question to ask is, last year, when were the tax forms sent out? And you want to hear some sort of answer before April 1st. Some funds don't have their act together and give out their tax forms in May, June, July, some even in September, right before the extension deadline. And that means that that fund does not have their act together. These are all just little data points that there is no one thing that is making a fund, a no-go, maybe, but usually it's a combination of all these things. I'm asking, are their financials audited by a third party? Do they have audited financials that they can send me? What is the investor portal that they use? And these are typically all of the questions that I'm asking. Again, first thing I'm doing is going through the investment deck and a webinar and trying to answer as many of these as I can on my own in about an hour time frame. And then, of course, there are going to be a lot of gaps in here and things that I couldn't find or weren't easily findable. And then I schedule that operator call for an hour, and I go through and I now know exactly which questions I want more detail on, and I can ask that operator. Then there's also due diligence that I do outside of the materials that they provide me and that interview, right? So I'm asking myself, do I have a strong relationship with the sponsor before evaluating with the deal? Sometimes you do. Was I referred to this sponsor or this deal by someone that I know, like, and trust and has already invested with this sponsor? Again, a data point that I think is worth covering. Do I know any investor that's invested with this operator in the past with positive results? Does a Google search show any negative or positive publicity in the last 12 months or 5 years? So what does that look like? That means I'm pulling up that firm and I'm going into Google and I'm saying, hey, DLP Capital search, DLP Capital fraud, DLP Capital felony, DLP Capital capital call. And I'm going through and I'm doing that search result. And then I'm taking a screenshot of the results and putting all of those screenshots into my due diligence folder. Why? Because it's one thing to, maybe do some of those basic searches and say, oh, no, I didn't find anything. It's another thing to go through and say, okay, I've done all these research. I have 5 or 10 screenshots of doing all this analysis. And when you come back to the deal, maybe 3 or 5 years later, you can go back and see what were the results at that time. Has anything changed? Was there something that I missed? What you're really trying to do here is have a system, a process that you follow for every single deal that you look at so that you make sure that you understand the whole picture about what you are investing in. And when you don't ask these questions and you don't go through the thorough process, that is where you make mistakes. And there are some things that you may choose not to do. Something that I'm getting into now is doing background checks. Hey, cool. I have a background check report for this operator. I go to checker.com or, you can run these basic searches. Do they have any speeding tickets? Have they been in court for anything? And again, these are all questions where you might choose to do them or not do them. But after you get burned on a deal or two, you just realize I'm adding that question back into my list. Another thing that I would look into from an amazing service that just popped up is Invest Clearly. Part of my due diligence process is I am going to investclearly.com and I'm plugging in the operator and I'm seeing what kind of reviews do they have. Do they have any reviews? Are the reviews positive or are they negative? You can very clearly see the experience other investors have had. I'm asking myself, is the sponsor active on LinkedIn or any other professional platforms? I actually think it's a plus if someone is looking or active online because they have a social reputation and more to lose. And then, I think the last part of my due diligence checklist is just links to all of the materials that I've looked at in this process. So I'm adding links to different podcast interviews. I'm adding links to their investment deck. I'm adding links to webinars or any presentations. I'm typically recording the call that I have with the operator so that I can go back and listen to it maybe one more time and see, okay, was there anything in this conversation that I missed or that I need to re-ask? And, ultimately it's these are all questions that are designed to help you reduce your risk in a deal. The more you know up front, look, you're investing 5, 6, 7 figures into these deals, and you want to make sure that you've crossed every T and dotted every I. And if you want to actually start using this process, obviously you can piece together, listen to this episode and piece together all the different questions from this checklist and create your own. I imagine, maybe you're putting one of these together, but if you want the full version, the one I've built and refined and that I use with my clients, that's available inside my coaching program, maybe you consider hopping on a call and seeing if a coaching program is right for you. If you're looking for deals to practice this on, I recommend going and getting my list of deal flow that is free for you. Go to passiveinvestingstarterkit.com and you'll get access to my entire list of over 800 deals. You can narrow it down to whatever asset class you're interested in, whether it's credit funds in this case of my checklist, self-storage, multifamily, whatever it is, and start putting together this kind of checklist and make sure you're asking the same questions to every operator. Again, this is a tedious process and it is designed that way on purpose. You should be spending 5 to 10 hours looking into these deals, asking the same questions for every deal, seeing patterns and understanding how different operators ask or answer these questions compared to one another. And that is ultimately how you will become confident and understand that you are putting your money in the right place. You need to look at a lot of deals, ask a lot of questions and the same questions to every operator. And then after you've done that 10 or 20 times, then I guarantee you will feel significantly more confident and understand the opportunity that you are investing in. There are no shortcuts to conviction, and the reps are the reward. So run the process, ask the hard questions, and your confidence will catch up to your capital. And with that, thank you for listening to the Passive Income Playbook here on the Best Ever CRE Show. If you enjoyed today's episode, let me know on LinkedIn or in the comments anywhere you are listening or watching this show, maybe on YouTube or on podcasts. Hit the subscribe button, leave us a review. It helps us leave more investors just like you. As you know, with me, every new episodes drop every Thursday, and I'm here to help you become a better LP investor. Again, this is Pascal. Thank you for tuning in, and I will hopefully see you at the Best Ever Conference in Salt Lake City in February, and at the very least, see you on the next episode on the Passive Income Playbook.